All right, traders, a very warm welcome to you all. I hope you're doing good. I hope you are safe in this COVID pandemic situation. So, in today's video, we'll be talking about the top three mistakes, the most common mistakes that we make in stock market investments. To be honest, these are the mistakes that I've personally made when I started out with my trading journey. So, I hope you watch this video till the end so that you don't make these mistakes going forward. So if you're just starting out your trading journey, if you're a beginner, make sure you watch it till the end and keep these mistakes in your mind because they can really blow up your account. And at the same time, if you are already into trading or if you are an established investor or trader, just keep them in mind because a lot of times we get overconfident and we keep on saying that this time it's different and it won't go wrong this time it's different, but we always tend to make those same mistakes and are emotionally driven to blow up our account. So without further ado, let's get started. But before I move on with the video, make sure you give us a thumbs up, subscribe to our YouTube channel, and leave us a comment. We really love to read all the comments that you write, all the messages you send us on our Instagram and on our emails. We love to read every single one of them. It gives us a lot of motivation to keep going forward and keep on doing that. And we love to help you out in your trading journey by creating such educational videos for all of you. So, yeah, let's get started. All right, the most common stock market mistake number one, investment in penny stocks. Let me give you a scenario what I'm talking about. So you just graduated from college, okay? Let's assume, you have around 10K of your capital saved up. You just went to your broker, opened a demat account with your broker. You want some more money to invest. You go to your family, they give you, some couple bucks because you just passed out of college. You want to take care of your finances. So you have your own 10K. You take 10K from your family. So you have a capital of 20K with what you're starting. Maybe if you're well off, you start with a capital of 50K. It totally depends on what your economic scenarios are. Let's not get into that. So what happens? 20K is your account balance. You have opened your demat account. The next day when the market opens at 9:15, we are looking for stocks to invest in because we're so excited. Adrenaline is high. And what do you see? What are the big names that you see? Reliance, HDFC Bank, all these big companies. Firstly, you're not going to invest in companies like Page or Eicher Motors, which are trading at 20K right now. So because that's going to just make your account zero and you won't have any balance left to invest, right? So then it comes, will you invest in companies like Reliance or HDFC Bank? You might, but your psychology, human psychology, will not allow you. Your emotions are not going to allow you. Why is that? Because Reliance right now is trading at 2000 rupees per share. If you have an account balance of 20,000 and if you invest like 5 6 stocks of Reliance, you have nothing left to put out. You have no cash basically left to diversify and take advantage of opportunities. So again, Reliance is out of the option. And also, if you have it in your mind, Reliance in normal scenarios will not give you very good return. If you want good returns from large caps, you have to sit in the market for some time, maybe a month or two, and then get the optimum, maybe a year or so to get the optimum returns. So finally, what do? With that 20K saved up, you go fishing for cheap stocks. And then you come to this term called penny stocks because these are the companies trading at 10 rupees, 20 rupees, 5 rupees. And then you have this thought to your mind, why don't I buy like 20,000 shares of this company or 10,000 shares of this company and my account going to multiply? And what happens? 3 months later, when you open your portfolio, two things can happen. 10% of the times, very few 10% of the times, you might have your account balance doubled or tripled. If you have that, kudos to you. But 90% of the time, what happens? You have 50% loss, 60% loss. Your account probably has already blown out and you quit your trading journey, before it even started. So that's where I come to the concept of penny stocks. Let me give you an example what penny stock is. A penny stock in India basically means a stock trading below rupees 10. It's not a concrete, it's not a a definition or anything, but generally it's considered to be a stock trading rupees 10. They are micro cap, nano cap companies, as I like to put it. So they are basically much below the small cap companies, very low market capitalization companies, much less than 5,000, maybe like 3,000 crore, 2,000 crore market cap, etc. Number one, why do we invest in these stocks? Why does our emotion allow us to invest in these companies? Luckily, I have never invested in these companies. I still don't have these companies in my watch list, but we invest in these companies because they can turn out to be multi-baggers and they can give us in a couple of days 100% returns. Let me give you an example. This is a chart of Jay Prakash Associates on the one-day chart. So around 3rd of April, the stock was at 1 rupee only. If you bought 10,000 shares, so if you have 20,000 capital, you can easily buy 10,000 shares, and with a capital of investment 10,000. So in a couple of days, in just a matter of 2-3 weeks, that 1 rupee share has become around 1.8. So you have literally made 80% investment return on your capital within just 2 to 3 weeks. And this is not the case with large cap or mid cap companies. So your 10,000 initial capital has just become 18,000 within 2-3 weeks. If you had invested this money in Reliance, that money would be like maybe 11,000, 11,500, that or 12,000 if the scenario is normal. So that's your penny stock investment, because we expect these companies to turn to multi baggers. That's our human psychology, because we have this thing in mind: buy low and sell high. So what are the features that I am telling you? Why do I tell you basically not to invest in these companies? There are no hard and fast rules, just my way of putting the things. So it's totally up to you how you do your analysis. Number one is circuits. These companies, the very, very small, very low cap companies, basically penny stocks, as I would like to put it, they are most likely to be indulged in circuit. Circuit means they will be locked in a whatever range they are, 5%, 10%, whatever, depends upon the company to company. So when they achieve a particular threshold, the share will be getting locked in a circuit, so you can't get in or you can't get out. So if you are in an uptrend, things are good for you, things are rosy. At the same time, you can also be stuck in a lower circuit. So when things go in a lower circuit, you are not able to exit. So in this example, if you didn't sell at 1.8, you would be getting stuck in a lower circuit, shares going all the way down to 1.3. And this is the first time where there is some kind of liquidity in the market and you can exit the positions. So the biggest flaw about a penny stock is its illiquidity. Sorry, circuits. It gets stuck in circuits too soon. If you are in the right direction, you make a lot of money, but at the same time, you can go down and also lose a lot of money. So both the things are possible. The number two is, with the circuits comes the illiquidity. Things are illiquid when you are in the situation of penny stocks. Illiquidity means not a lot of people are trading in this. Let me give you an example on the 1 week chart. If you open the 1 week chart, you can see very well this stock is trading between 1.92 rupees to just 2.5 rupees for a matter of, since 26th August all the way to 23rd December. So for 6 to 7 months, stock was stuck in a 50 paisa range only. So things are not very liquid. So when things are not very liquid, what does this mean? You have already seen it with this example. You will not be able to sell at the price that you want, because, as I said, there are so many circuits going on, there is so much illiquidity, you are not able to sell or exit at the price you want. You have to accept the price that is given to you. As simple as that. So that's another drawback when coming to your penny stocks. Number three, we invest in penny stock, as I said, because there is a 5 out of 100 or 5 out of 1,000 chance that these companies might turn into multi-baggers. These companies might turn. I'm not saying they won't turn. There are hundreds of companies that have turned multi-baggers from these. So if you have bought like 10,000 shares at 5 rupees and this company goes to 50 rupees, so you have just made 4,50,000 rupees on your just 5 rupee investment. So these companies can turn into multi-baggers. Please don't take me wrong. But the probability is just 5 out of 100 or 5 out of 1,000. So you have to be very, vigilant in selecting these 5 winner companies. but most likely we end up with that other 95% losers. And finally, the last reason of not coming into the penny stocks is your manipulation. I think all of you are already aware about that. Manipulation is very, very common in these companies. By manipulation, I mean that the company share can just go up or it can just go down because very few people are involved in these companies. So, the big players, they can just push the price up or push the price down depending on whether they want an exit or whether they want another entry. And all of us retail players, we just get washed out. So this is one common mistake a lot of new investors make of investing into penny stocks. So whenever you invest into penny stocks, again, make sure you have these drawbacks in mind and weigh it out with your benefits. So do a cost benefit analysis and then decide whether these companies are good for you or not. So some examples of penny stocks are Trident. I won't say it's a penny stock, it's actually much more liquid than the other penny stocks, but still, stocks below 10 are penny stocks. Try to stay away if you can. Um, so another example, GVK Power trading at 265, and another example is the Paramount Communications trading at 715. So these companies are penny stocks. Try to stay away. Depends upon the volatility, the liquidity in the market. All right, traders, mistake number two, don't buy stocks in a downtrend. As simple as that. And I absolutely hate this because I've done this mistake with Vedanta. So I'm here to show you the example of the mistake I made a couple of years back actually. So this is a daily charts of Vedanta. Why did I buy this company? I bought this company around 300 levels. It used to be a very good company back then. Now, obviously, it's got the delisting news all around it. It's a lot of speculation going on. But back in 2018, 2017, this was a very high, very big cash rich company, a lot of capital expenditure. It was a market leader in its segment. And also, the primary reason why I bought Vedanta was the dividend yield. I think it still has the highest dividend yield of 2120% in India. So that was actually the main reason why I bought Vedanta. But my main problem was when I bought Vedanta, it was in a downtrend. So when things are in a downtrend, they will keep on going down. They are not going to go up. Remember that. So don't buy stocks in a downtrend. So the question is, how do you define what is a downtrend? So if you are a trader already, you know your rules, the lower highs, lower lows. But if you are an investor, if you are starting to trade, I'll give you a simple formula. Put the 200-day moving average. You can just go on the indicators and open moving average with a 200 setting. Open the daily charts. So as you know it, 200 moving average is a very good long-term support or resistance. As you can see from 2016, you are above the 200 period moving average. So this becomes a very strong support. And if you are above the 200 moving average, you are in a bullish market. And once you go below the 200 average, you are in a bearish market, you are in a downtrend, and this will become your resistance. That's the basic rule in 200 moving average trading. But please remember that don't just buy or sell based on this. Please combine other tools and strategies when you are trading or investing. It's not that easy. But that's just a very basic idea of how to tell you what's an uptrend or what's a downtrend. You can also use a golden crossover or death crossover in this example. I have done a segment on that a couple of days ago. So coming back to the mistake, don't buy stocks in a downtrend. So what this means is if you are in a downtrend, let things go down because your primary trend is down. So you want to take advantage of this. You want to be short or you want to stay, if you are investing in the company, you want to stay out because we don't want to take advantage of these small pullbacks or these small pullbacks or these small pullbacks. You want to take advantage of the primary trend because in technical analysis, you have to trade with the trend because the trend is your friend. As simple as that. So remember that rule in your mind. Let me show you another example. Indiabulls Housing Finance. I absolutely stay away from this company. It's a primary downtrend. You can see you are below the 200 moving average. You're taking a lot of resistance. As I said, if you're below, you are going to be in a primary downtrend. So you are, as you can see at the current price also, you are at a good resistance level. So if you break out, then probably you are okay. But I'm not going to go with this company. It's a primary downtrend. Don't buy such companies. Edelweiss, another example. So please remember, it's my own analysis. You should not just say do what I say. Use your own mind and analysis also. Edelweiss also below the 200 moving average in a primary downtrend. One word of caution I have out there is that in this coronavirus pandemic, things have really gone down a lot. So a lot of stocks that you see will already be below the 200 moving average. Why? Because of this huge fall that we saw a couple of months back. So currently, just use your own analysis on how to decide if you're in an uptrend or a downtrend. But that was my simple logic behind things. One final example of a good uptrend is Deepak Nitrite. The sector of chemical fertilizer is in focus. You can see very well. You are respecting the 200 moving average. So this is a stock that you want to be in. You are in a good uptrend. So buy such stocks. As simple as that, guys. Right? So there's a saying that people say this, that you have to buy low and sell high. Right? You must have heard this. Let the price fall, buy low and sell high. Let me give you another way of putting things. Why don't you buy high and sell higher? Think about that. You're already buying high and selling higher. What do I mean by that is, if this is the coronavirus crash in Deepak Nitrite in March from 530 all the way down to 308, right? So currently you're trading at 606 rupees per share. You're already trading very high, correct? So buy high and sell higher rather than waiting for the price to correct all the way to 340. It's not going to correct till that because the stock is doing good. And one thing that I've missed about the penny stocks is the reason these companies are trading at very small amounts is because these companies are in stress. Remember that. Companies trading at very low amounts is because they might have some defaults, they might have some huge debt obligations that they have to fulfill. So just because they're trading very cheap doesn't mean they're very attractive. They look attractive, but they don't mean they're very good. They are in huge distress and might not have a going concern. So just bear that in mind when you are coming into these companies. And again, last example is Gujarat Gas. I'll just move on quickly to the last mistake. Good uptrend, holding the 200 moving average, keep on bullish of this trend, buy at the correct price, let the price come down, correct a little, and buy because it's in a good uptrend. And finally, the last mistake. I think this is the most common mistake, and everyone probably has made this mistake. If you have made this mistake, just mention in the comments and give this video a like. So mistake number 3: don't trade on the outcome of earnings. So sounds familiar? Let me give you an example. When we have any listed company in India, as per the SEBI regulations, has to post quarterly earnings every quarter. So 4 times they have to post an earnings in the year. So currently we are in a quarter 1 earning season. It's about to get over in India now. So what happens is every single day a different set of company are going to come out with their numbers. And what novice investors are doing, they wait for the numbers. If the numbers are good, we go long on the stock. If the numbers are bad, we short the stock. We are doing, it's common human psychology, because positive results mean the share should go up, negative result means share should go down, correct? But that doesn't happen, and that's another reason why people blow up their account, because they put so much money in a trade like this. They think that this time it's different, we are right, and guess what? You're gone, you're out of the market in just no time. Why does that happen? Again, what is technical analysis based on? Dow theory. What is Dow theory? Principle number 1 says, it says that market discounts all information. As simple as that. That whatever happens in the market is already discounted. So remember this: if there is a good news in the market, it means it's bad news for you. If there is a bad news in the market, it means it is good news for you. If a good news comes in the market, the big players, they are going to dump their shares. And if some bad news comes in the market, the big players are going to buy the shares irrespective. So they are just making a fool out of all the retail players, all of you watching this video right now. So you have to be careful, right? So let me explain this now. I'll give you 3 examples. Just happened last week. If you want all these quarterly earnings, all the real-time stock market updates, just message us on Instagram or on our website. We'll send you the link to join our stock market community. We are sharing live market updates, research, reports, etc. Right, coming back to the video now. So Finolex cables, one-day charts. So Finolex posted their quarter one results on Saturday. Saturday is the 15th August. Yeah, Saturday 15th August. So see what happens. So 15th Saturday Sunday markets are shut, right? What were the numbers? Quarter one profit 445 million and all the way versus 970 million. So you can see a big plunge in the profit. The quarter one revenue came at 3.77 billion versus 8 billion last year. So you can see the results are very bad. It's a big plunge in profit, big plunge in revenue. So what should happen to the share price? The share price on Monday. Why Monday? Because Saturday, Sunday markets are closed. So the markets will react to the news only on Monday. So today, 17th August, the price should go down significantly, right? Because the results are so bad, maybe 50% plunge in the profit. But see what happens. The markets on Friday closed at 280 rupees per share, and on Monday, irrespective of the results, you went up higher by about what's the price? I'm sorry, 279 all the way to 290. 11 rupee per share you went higher, and you're still after the news closed higher. So you have not went below that low. As simple as that. Good news, sorry, bad news means what? Good news for the market. Don't just trade on this principle I'm teaching you, but just keep this in your mind. Trading on these news events days will be highly volatile, so you might want to be careful and trade low. I would suggest trade low quantity if you're trading and have a wide stop loss because to have that risk constant. Another example, Alkyl Amines posted quarter one earnings when on Friday, that's the 14th of August. And what's the earnings? 774 million net profit versus 592 million. Amazing results, right? EBITDA margin 31% was 22%. It's a big 9% increase in EBITDA. What do you want? What else do you want? It's a crazy result. Great company. It's Pierre Balaji Amines, Alkyl Amines. They've been in focus and they've gone up like 1000% in the last 1 year. And see what happens on the day of the result, on Friday, the shares should go higher, right? But the shares from 2880 dipped all the way down to 2700. So they went down to 180 rupees, even though they posted a great, outstanding set of numbers. So good news means bad news. So if you had bought the shares, unluckily, you would have blown your account. Just because you were trading on news and things have already been discounted, big players are just dumping their stock. Last example, Trent. Another event happens. Quarter one results 13th. 13th is around, yeah, the screen candle. So a net loss, a big net loss, 1.8 billion versus a profit last year of 363 million. Sorry. So you can see it's a big plunge in the profit. What's the revenue like? Revenue is 2.5 billion versus 8 billion. It's a big plunge in revenue as well. So the share should plunge, right? If you shorted the stock on Friday, you've blown your account. Why? You can see very well that the stock from 554 went up all the way to 590. A 40 rupees jump in the price irrespective of poor results. So I think I made my point clear. So remember these three mistakes. Number one, trading in penny stocks is risky. These companies are in distress. You want to be careful. Number two, you want to buy stocks that are in uptrend. You don't want to buy stocks that are in downtrend. Okay? Buy high, sell higher. And finally, don't just trade based on the news. Have a good concrete analysis. And if you are trading on news days, make sure you have small positions and a wide stop loss because stop loss will be likely to be hit on that day due to the increased volatility. So I hope you enjoyed this video. Don't make these mistakes again if you have done that already. And give it a thumbs up, subscribe to our channel, leave us a comment, give us your reviews on Instagram, on our website, on our YouTube, whatever you are comfortable with. And yep, that's all for now, and I'll see you tomorrow.